The stock market today. It's Thursday, October 3rd, 2019. I am your host, Dan Russo, the chief market strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock market today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today to sign up for a free email where you can get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities were under pressure again on Wednesday. S&P 500 has now posted two consecutive declines of 1% or more. First time that's happened in 2019, and it's down in 4 of the past 5 days. Treasuries rallied in a flight to safety. The dollar was weaker versus the yen and the euro. Gold finished up 1.3%, so a little bit of a safety bid there as well. WTI crude lower by 1.8% and down for the 7th consecutive day. As we get to the desk this morning, futures have been hovering back and forth around the unchanged line, now up about 10 basis points off the best levels of the morning. Asian markets were mostly lower overnight, led by Japan and Australia, both down over 2%. China still closed for a holiday. European markets are trading higher, though Germany is closed as well. Treasuries are stronger across the curve, extending their recent rally. Dollar is weaker on the yen, but better on the euro. Gold down 10 basis points, and WTI crude following through to the downside, another 50 basis points. As we dig into the S&P 500, we get a bit of a change here. Something different to talk about today is the S&P 500 closed below the key 2,900 level. If we fail to hold at current levels, and I've drawn the uptrend line here off the June lows, if we fail to hold here, we have to start thinking about the August lows down around 28.20. Now, you do have the rising 200-day moving average roughly in the 28.37 area. And as we start to think about a potential rally, resistance, former support at 29.50 becomes resistance to a near-term rally. And then beyond that, the psychologically important 3,000 level. Now, the RSI has moved lower, and this is something we've been keeping an eye on very, very closely. We would love to see a quick rebound here along with the market. In an ideal world, we'd love to see the market quickly rebound above the 2,900 level and back into that key support area. Now, Chaikin money flow does remain bullish. Obviously, it's pulled back with the decline over the past couple of days, but it does remain bullish, and it does remain in a near-term uptrend. So it really is a bit of a mixed bag here. I think the next couple of days are going to be telling for the market. If we fail to hold here, further downside. If we can quickly rebound and get back above 2,900, we can start to build that base building process and start to get going back to the upside. So the next couple of days, really important here for the broader market. Now, as we dig in, what are we talking about in my note today? To Chaikin Analytics clients, we hit on the back-to-back declines of more than 1% for the index, the broad index. Breadth metrics weaken as the market closes below key support, and you would expect that. However, short-term measures hint at near oversold conditions. We'll talk about what that means a little bit later in the show. Crude oil weakness weighing on the energy sector. I'm starting to get some questions about whether it's time to go bottom fishing in energy. I don't think so just yet. And as I said, futures do point to that slightly higher open today. So here is the damage on the day yesterday. Red across the screen and deterioration for the power bars. For the most part, the Dow loses 1.75%, 7 bears to only 1 bull. S&P 500 down a like amount, 1.75%, 115 bears to 64 bulls there. NASDAQ roughly in line, 25 bears to 10 bulls. Small caps actually an outperformer yesterday, and we're going to take a look at the small cap chart because it's something that I'm watching closely. 469 bulls, 407 bears in that stock. It is the only index skewed to the positive side from a power bar perspective. Flight to quality sent bonds higher in price, taking yields lower. So according to the Chaikin Power Bar, small cap stocks have become somewhat more bullish than large cap stocks, and the major markets across the board are mixed, but I would say they are mixed with a bearish skew. Taking a look at our stock of the day now, one of the investment bankers and managers, INTL, very bullish rating. Stock closed at 39.57, down 1.4% yesterday. So actually a slight outperformer. Power gauge rating is very bullish due to very attractive financial metrics and strong price volume activity. And when we take the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating. So we have a very bullish stock, strong trend, strong industry group. So it's a type of name we want to consider And what we have going on here is what we like to refer to as a bit of a personality change. That bullish rating is now being met with a stock that is outperforming the market. It is oversold. Money flow has turned bearish here, though. So, not the highest conviction idea. I think if I was looking for opportunities here with the sell off in the market, there might be some better names out there. But if we take the weight of the evidence approach, INTL does look somewhat interesting to me. What I would love to see is for it to hold our rising long-term trend line and hold above this kind of $36 to $38 zone and give money flow some time to turn bullish, and then it becomes interesting. So it really comes down to, if you're on the more aggressive side of the ledger, this kind of looks like an interesting name here on the pullback. If you want to be a little bit more conservative, give the market some time to find its footing, you can add this one to a bullish watch list and keep an eye on it in the days ahead, because if this money flow indicator starts to turn positive, then this really does become a compelling opportunity on the long side of the portfolio. Turning now to our sector tracker and our industry in focus. At the sector level over the last 5 days, all of the major sectors of the S&P 500 are negative. Now, you'd expect that back-to-back 1% declines, market under pressure. So what we like to do is look for where the relative strength and weakness lies. And from that perspective, not a lot has changed. The relative strength, and in this case, it means going down less than the overall market, the relative strength is still in the defensive areas of the market, and the yield plays or the bond proxies, real estate, utilities, staples, and healthcare, all considered defensive sectors of the market, although I would note that within healthcare, you have to kind of cut it a little bit more finely than that. Middle of the road, discretionary tech materials and comms, and then the underperforming groups, industrials under pressure with that ISM number. Financials, as rates head lower, the financials are back under pressure. And as we said earlier, oil down 7 days in a row. That has weighed on the energy complex. We've been talking about energy for a while as a group we want to avoid. We're going to take a look at it a little bit deeper later on in the show here. Turning now to our industry in focus. And the industry in focus for today is retail services. And this has been a lagging group. This hasn't been another one of those groups, the energy groups, pharma, retail. Whenever we've been talking about bearish areas of the market, this is an area that's been popping up because over the past 6 months, it's underperformed the S&P 500 by 8.8%. And the power bar ratio, which measures future potential, is still weak. 25 bearish or very bearish stocks for only 18 bullish or very bullish stocks here. That earns it a rank of number 9 of 21 subsectors that we look at. It's moved up one slot over the past week. And some of the indicative names there, names that if you own them, you might want to reconsider. You might want to manage your risk a little bit. Or if you look for opportunities on the bearish side, these are the types of names you want to consider. Now, what I will say, with the group under a lot of pressure, these names are mostly oversold in the near term. But names to keep an eye on are Carvana, CVNA, with a very bearish rating, Grubhub, GRUB, with a very bearish rating, and National Vision, EYE, also with a very bearish rating. And as we take a look here at the group itself, the power gauge ETF rating is neutral, but the trend is weak with the fund below a declining long-term trend line. Remember I said a lot of the stocks were oversold. Same goes for the fund. It is oversold, but look at this underperformance. This group has been underperforming the market for the better part of 12 months, right? When we talk about relative strength, this is not relative strength. This is relative weakness. Something that I like to do when the market gets choppy, as it has over the past, call it week and a half, is look for the pockets of strength in the market. And this is not one of them, right? If you're looking for ideas that could potentially be leaders, should the market stabilize, you want to look to the areas of the market that have been outperforming. Retail, not it. Now, we've seen a dampening of the underperformance, but we're just not there yet. Continue to avoid retail until evidence supports taking a different stance. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. One of the areas of the market that has shown relative strength where we've been bullish has been home builders, and Lennar did not disappoint with their earnings announcement. Stock up 3.77%. PayX, PAYX, also had earnings yesterday. Stock higher by 1.78%. That was in a tape that was down 1.75%. Johnson & Johnson settlement announcement in an opioid case sent that stock higher by 1.5%. Charter, court upheld net neutrality repeal. That sent that stock higher by 1.27%. And Win was higher on some gaming numbers out of Macau. On the loser side of the board, I didn't see any real news on Mattel to send that stock lower, although the retail consumer levered names were under pressure due to that ADP payroll growth softening and September and the August number being revised down. So that accounts for the weakness in Capri down 5.8%, Macy's down 5.8%, and Kohl's down 5.75%. Nectar NKTR announced some abstracts that they are going to show at an upcoming conference. I guess investors didn't like what they saw there. Stock down nearly 6% on the day. So again, focus on the relative strength. The areas of the market that have been performing well actually are continuing to hold up on a relative basis. And that's why a name like Lennar can outperform to the extent that it did. So what are we talking about further in our note today to Chaikin Analytics clients? Thursdays, we do breadth. We look at market breadth for the S&P 500, and we look across the board at a few breadth metrics. One of the key breadth metrics is a measure of kind of the long-term trends within the marketplace is the percentage of stocks currently above their 200-day moving average. And you can see it's about 59%. 60% is a sign that a healthy majority of stocks in the index or in long-term uptrends. And I think if we break below this 50 level, that would argue for further downside in the market. So far, we're holding up, but we obviously have deteriorated with the market here a bit. You can see the S&P 500 at the bottom of this screen. What's interesting to me is that when this metric is over 55% and the market's above a rising 200-day moving average, the index is usually higher 6 months later, 79% of the time for a median return of about 5.84%. So keeping an eye on the long-term trend and noticing that on a shorter-term basis, if we look at the stocks above their 50-day moving average, we're getting down to levels near 30% that have marked local lows for the S&P 500 in the past, right? Back in June, we got down to 30%, local low in the market. Back in August, we tagged that 30% mark a couple of times. That built a support level from which we eventually broke out, right? So something to keep an eye on here, because if we do break below 30, as we did back at the tail end of last year, that does argue for further downside in the S&P 500. And what's interesting to me is if we take this analysis a step further and look at the percentage of stocks above their 20-day moving average, that's down to 11%. So short-term breadth metrics are starting to get to oversold levels. So if the market is going to stabilize, this is a great spot from which we would expect to see stabilization. Short-term breadth metrics oversold. Would love to see the market follow through and in the next couple of days push back above the 2,900 level. That would be encouraging going forward as we get through what the normal volatility in October to potentially set the stage for a rally into the end of the year. So we're continuing to watch the breadth metrics closely, and we'll continue to highlight them every Thursday in our work here. Now, I said we were not bottom fishing in energy, and here's why. Here's the XLE completely breaking down. Tried to rally following the spike in oil after the attack in Saudi Arabia, and now giving all of those gains back, falling below the 200-day moving average, the 50-day moving average, shaking money flow, turning bearish for the XLE, the energy ETF. And look at that scooter line at the bottom of the screen. I mean, just complete underperformance, no upside momentum on a relative basis. And we think that that's likely to continue. Why is that? Because we have a bearish rating on the fund, and the power bar ratio is very bearish, right? 17 bearish or very bearish stocks in the XLE for only 3 bullish or very bullish stocks. So odds favor a continuation of underperformance by energy relative to the market, which is why, even though I've been getting some questions of late, we are not bottom fishing within the energy complex. Finally, I said I was watching for a turn in small caps. Why is that? Because of this hammer candle yesterday. Small caps outperformed on the day, and we are holding above support at the 145 level. What's jumping out to me as well is that these last few trips down to that support level did not produce an oversold reading on the RSI, and shaken money flow is holding in bullish ranges. So I think if small caps can hold support here next couple of days, going to be important. That could increase the odds that the S&P 500 will retake that 2,900 mark that I've highlighted a couple of times today as being really important. So that's going to wrap it up for today. Head over to chaikinanalytics.com/today for the email. I will be back here tomorrow. Have a great Thursday, everyone.